please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Taking Stock, the show where we take stock of the week gone by and of course prep you up for what lies ahead. I'm Surabhi Upadhyay and with me as always is Anuj Singhal. And the week gone by, Anuj, I don't know what to say. I mean, uninspiring, maybe if I were to put it, simply because the global markets, the US market showed signs that maybe the worst of that volatility is behind them. But we were hit by our own set of woes, right?
Yeah. So this week we were decoupled, Surabhi, but obviously for all the wrong reasons.
On the way down.
On the way down. Last week the hope was, can we get decoupled? This week I think the hope would be that why did we get decoupled? So because it was on the other side. There's a local factor, and the market does not like the word fraud. And my sense is that this has been a culmination of a lot of events, starting with the budget, the long-term capital gains tax. After that, the couple of issues, the couple of macro numbers not looking good. Then, of course, we had the global volatility, and of course, the nail in the coffin was really this whole PNB issue. The big question is how much more in terms of the contagion damage for the banking system and for the market from PNB. We'll find out. The Bank Nifty is now trading below the key moving averages. Only the 200-day moving averages left. And the sense I get is that that might be tested because that was the leader of the market. But the expiry week is next week. The momentum is with the shorts. Monday becomes crucial. If Monday market has a big rally, in that case there could be some short covering. But if Monday you continue with this gap up and then the market getting sold into, there's a good chance you get a gap up on Monday because a lot of Asian markets will react to US market. US market themselves have been doing well. So that way Monday again you get a gap up maybe. If that gets sold into, once again the shorts will be back. Covering is possible if this PNB issue is resolved. I think the amount of shorts in the system now is large. So obviously what it requires is one bit of covering move and you would have some short covering, but that's not my base case scenario right now.
Well, yeah, I mean, absolute perfect cocktail of bad news for, in favor of the bears and against the bulls really this week, including some macro data points with the current account deficit number also touching their 56-month high. We will be discussing all of that with our guests on the show, and joining us this week to talk about all of these points is Vibhav Kapoor of ILNFS. Vibhav, welcome to the show. Good talking to you as always. Now, if we start listing out the factors right from the PNB fraud issue, let's not forget RBI's big norms on NPAs, the risk and the fear of higher provisioning, some of the macro data points. I mean, it sounds increasingly negative, but then that's the important thing. Maybe one shouldn't lose sight of the actual context. What do you think of the week gone by?
Yeah, it certainly was a week where we had all this negative news. One would have actually thought that, after the global volatility was reducing and the global markets were bouncing back, we would also bounce back. But I think the RBI news and then the PNB news, both of them had a really detrimental impact on the Indian markets. Of course, the RBI news, I think, is something which is more fundamental in the sense that markets might now reassess what FY19 will be for the PSU banks and would want to downgrade them. There was earlier hopes that in FY19 the PSU banks will recover. That might not happen now, although from the longer term it might be a good move. The Punjab National Bank news, I think, unless it has, there are some, more discoveries, I think as it is today, it's really should be an isolated issue and should not have any medium-term or long-term impacts on the markets. And at the same time, I think we must not forget some of the positive things which are there. I think there is a recovery happening in the economy. The earnings growth, I think, next year now seems more likely to come through than earlier. So the markets needed a correction. There's no doubt about that. We've been all saying that for a long time. And therefore, I don't think we should become too pessimistic either at this point of time.
Vibhav, that's a really good thought. And I must tell you that, I remember when it was 11,000, you were sounding very bearish. And now, you're sounding a lot more optimistic than many people. So you think the risk reward is turning favorable again? Or at what point do you think it will be completely in favor of the bulls to just go out and buy this market?
So I think, if you look at FY19, expected EPS numbers, etc., and valuations, I think around 10,000, 10,100, 200 is a level which now seems a little more realistic than it earlier would have seemed, because time has passed by. Again, I come back to what we talked earlier once. Actually, the market was first time touched 10,000 in May or June of last year. So it's been a good 9 months. And if you're back to, say, 10,000 to 300, we are pretty close to that. So we haven't really gone up all that much. And now, as I said, I think the coming through of earnings growth in FY19 and beyond is a little more certain than it was at that time. So I'd say it's maybe about at 10,100, 200, you'd be only about maybe, more realistic 17.5, 18 times FY19 earnings as against 20 times earlier. So I think that would be a level where the market should, for the time being, hold on. And unless you get more bad news in the economy, I think that would be a reasonable level to start at least nibbling into the market.
So, Vibhav, let's talk about the biggest problem point for the market this week. It was banks. The Nifty Bank down 1%, but of course, PSU Banks, that index losing 8%, PNB itself down 20%. Now, what is the sense? Is there any point in indulging in that nibbling in this arena in PSU Banks? If not in PSU, what about private sector names or NBFCs?
Yeah, certainly not in the PSU Banks. We've had so many disappointments one after the other, and the expectation that things will start improving, they haven't happened yet. Now I think this new regime which the RBI has put in, while it will have short-term pain for the banks, but once for all, somewhere maybe 6 months from now, 9 months from now, hopefully all the negative factors possible will get factored into prices. So we need to wait for at least 2-3 quarters before we even start thinking about investing in PSU banks. But the rest of the sectors in the market, including private sector banks and rest of the manufacturing sector, etc., where valuations are coming down to, I'd say, more reasonable levels, definitely at these levels, one could start looking into investing in those names. But having said that, I think there's a caveat, and that's the mid-cap part of the story. Yeah. I think the mid-caps had really gone up really much more irrationally than even the large caps. And therefore, they probably need a bigger correction than the large caps do. So I would still avoid the mid-caps. Maybe there's another 10-15% correction to go there. But definitely the large caps, apart from the PSU banks, as we said, definitely need to be looked at around those 10,100, 200, 300 levels.
Okay, that's interesting. Vibhav, the other thing that I want to ask you is that do you think the market's leadership is now changing or has distinctly changed already? Because autos this week were seeing brutal sell-off, especially the leaders like Maruti and Eicher Motors. We've seen what's happened with banks. On the other hand, Infosys and TCS are very close to their highs, and Midcap IT already is. So a lot of these IT stocks are making new highs even while the market is correcting. So in a sense, do you think the next move for the market would or could be led by IT?
So that's at least one place where the downside looks very limited now, and that's a space of the market which had not been performing earlier at all. And as we discussed, I think last time, things seem to be improving there a little bit. I think these companies have sort of partially, at least successfully, countered the new technological problems which have been there and the new areas of digitization, etc. So valuations have been pretty attractive there. And except for the rupee appreciation, I think things are really improving for them. So definitely these are companies which one should start looking into seriously now.
Okay. Vibhav, what is it that you would advise going in and buying right now? What would the best plays be, given that a lot of people seem to be suggesting that 2018 is maybe going to be a volatile year, not as straight line as 2017?
Yeah, it's definitely not going to be a straight line as 2017. And I don't think one should have expected that to happen at all. But what I'm saying is that, from, say, 10,000 or somewhere thereabouts, at worst, if things continue as they are, you would still have a 11-12% return in 2018. And if things go well, it could be as good as 15, 16, 18%. So the risk-reward ratio, again, re-emphasizing, I'm talking only of the large cap stocks, from those levels, I think is reasonably good. It does not necessarily mean that that will turn out to be the final bottom of the market. The market could go down a little bit further from there later on, but the overall risk-reward ratio for all the large cap names except for the PSU banks, I think is going to be pretty reasonable from those levels. And therefore, one should start looking at investing, as we said, in private sector banks, in technology, maybe a little bit in pharma, some of the maybe economy-related sectors like autos, etc., and probably metals, which on a global basis seem to be doing pretty well.
Okay, getting back to the question, the point that you made on Midcap, Vibhav, there's a bit of a fear of domino effect here, right? Because the entire rally of last year has been led by domestic flows. FIs have been on the sell side, and a lot of this money would have gone into the Midcap. So if you have this Midcap correction accentuating, isn't there a risk that the flows at large would slow down, and that would impact the large caps as well?
No, I don't think, that can be said on a generalized basis. You see, there are a lot of mid-caps which, just people speculated on as they normally do in a big bull market, and, they lose money thereafter, but that's fine. But as far as the good mid-caps are concerned, yes, probably they will do well at some point of time. All we are saying is that they had gone up a lot more than the large caps and therefore had become more unattractive, and therefore they need a larger correction. But at some point of time, I'm sure the domestic funds who still are incidentally sitting on a large amount of cash, remember, are definitely going to come in and buy those stocks or average them out, etc. But having said that, I think one thing that could also happen is that because the large caps are coming into a more attractive area where they're not so overpriced, even the domestic funds could shift some of their attention to the large caps, and that is how maybe the large caps could perform better at this point of time, because the domestic funds would buy presumably, as well as the FIs would come in at some point of time.
Okay, Vibhav, thanks very much for your time. Always good listening to you. Thanks for dropping in and taking us through your market call.
This is taking stock, and we are taking stock of a week in which the bears had real control, especially over the last 2 days when gap ups were sold into. The markets ended at low point of the day, and advanced decline on both days was about 1:5. So in that sense, the last 2 days, clearly, things were looking quite bad. Ashwini Gujral is with us now. Ashwini, so interesting, we have decoupled, but on the negative side, next week, what's the strategy? It's the expiry week as well.
I think we are leading on the downside. At least, we are leading somewhere. So, see, the point here is that, there is some sort of momentum which is now building up on the downside. And, when large stocks are coming off like, State Bank and ICICI Bank, plus now IT is also kind of caving in. So that way, I wouldn't be surprised if we have started some kind of a, restart of the decline, because Dow has gone up 5 days. Now, 5 days is statistically about the most a market can move in one direction for a bit. So in case that is also ready for a down day, then we are anyway outperforming. So people should be ready for 10,000, 10,100, which is the 200-day moving average. And similarly on the bank Nifty also, we should at some point go towards 24,600.
Okay, Ashwini, in that case, I'm guessing you have a couple of sell ideas for next week?
Yeah, Sun TV you can sell with a stop of 940, target of 900. JSPL has just started falling. That's a sell with a stop of 256, target of 240. And Bombay Burma Trading, that's a buy with a stop of 1495, target of 1540.
Okay, interesting. Let's take some Twitter queries then, Ashwini, and some of them are on stocks which are really, large caps, but were making a big move. The first one is from Sham Karani. 200 shares of Motherson Sumi bought at 340 and 50 shares of Mahindra & Mahindra bought at 750. He wants a 3 to 6 month outlook on both the stocks. So looks like got into both stocks at the higher end of the range.
See, Motherson is now trading below its 200-day moving average and looking at an intermediate style correction. See, once you decide to buy a blue chip, you should be ready to average. So if I were him and I got 300, I would average it down, because once the correction is over, chances are it will make fresh highs. So that's as far as Motherson is concerned. Although I would like to point out that you buy autos, auto ancillaries when a bull market is just about starting out. After 2 years of huge rallies, if you buy stuff, chances are at best you could be stuck in a sideways zone, or you enter into something and it starts to correct. As far as Mahindra & Mahindra is concerned, I don't think it's really done too much, and basically still in a range of 570 to 750. Now we've broken 750. So once something breaks one end of the range, it often becomes likely that it will go to the other end of the range. So this is poor buying. He shouldn't be very hopeful.
Okay, all right. Let's move to the next question. It's from Vimlesh, who has a question on Balrampur Chini. Now, he's got 1,000 shares. He bought them at a price of 129, so he is sitting on a bit of a loss. Ashwini, he wants to know whether he should book that loss or whether he should stay patient. He has a 6-month time horizon, but Balrampur has been really a laggard last 2-3 months.
See, that's the problem with the, sugar, that the cycle changes before you know, and it then comes off rapidly. It was at 31st of October at about 180. From there it's about 110. Now the way the stock is looking, it looks like maybe the cycle has turned, but still if he wants to hold on, keep a 105, 110 type of stop and hope that it goes back towards 145, 150. That'll help you exit. But the best time to buy such stocks are when they are going bankrupt. In commodities, that is the rule. Sugar, every 3 years these companies are flat on their face. Similarly with metals, etc. You buy them when at the top of the cycle it becomes impossible to make money.
Okay, take your point. The next question, Ashwini, and I think this is something that a lot of people will have on their minds. The question is from Dhananjay. He wants to invest 2 lakh rupees in equities for a 3 to 5 year period. He's wondering whether this is a good time and if you could suggest a couple of stocks to him.
See, this is a good time, but get into stocks which are overall good stocks but in correction. So add a couple of NBFCs like Bajaj Finance, L&T Finance. Add a couple of tech stocks, particularly things which are doing well, things like 8K Miles, cloud computing, or Sonata Software, NIT Tech. So make a mix of both these spaces, and chances are over the next 5 years this sort of portfolio should do well.
Okay, all right, Ashwini. Thanks very much for being with us and taking the viewer questions, also giving us the market call. You have a good weekend. We'll see you again next week. That is a wrap on Taking Stock. Thank you very much for watching. We will leave you with a whole host of market opinion that we picked up during the course of the week. Have a great weekend.
There is some kind of stress. I won't call it a stress, but some kind of correction, which I would call it a healthy correction going on in the market for 2-3 weeks, especially in the mid and small caps. That has been more evident. Things are very healthy. Markets are looking, not in any kind of bubble territory. It looks very reasonable and healthy to me.
Clearly, I think the return expectations for 2018, even at the start of the year, were a lot more modest than I think most of the participants, and we continue to maintain that this year the returns will not be so great. If you recall, at the start of the year, we said we're expecting an upside of just about 10% for the Nifty and the Sensex. The underlying corporate earnings recovery outlook, not just in India, in fact globally, is still looking very, very robust. So it's mainly interest rates going up, but more accompanied by stronger growth. So therefore, for equities as an asset class, we are still reasonably constructive.
This very dramatic and sharp rise in interest rates in the US has been in a surprise for everyone. I think we all were, kind of thinking that it's going to be very gradual, and it all depended really on the Federal Reserve to signal interest rates to rise. But the market seems to have taken up the gauntlet and decided that it decides to price it before the actual action, which in one way has negated any downward movement or say an impact or a reaction to any Fed move from here on. So it's more or less taken up even 2 or 3 more interest rates hike that the Federal Reserve could have possibly taken.
I don't think there's any big change in sentiment or the fundamental drivers in terms of financialization of savings and all that. So I don't think there's any cause to worry at this point of time. Long term, I don't think interest rates should be going up too much from here.